Hey there, welcome to the Kisaki. I'm Lakal here and this is the second episode of the series on how to trade Forex. While you're watching this episode, if you have any questions or doubts about the points that I talk about in this episode, please put them in the comment section. Or else you can reserve a time slot to have a quick call with me by visiting the URL thekisaki.com/connect to clarify any of the queries that you have for free. To get notified right away when a new episode gets published in this channel, don't forget to subscribe to the Kisaki and enable alert notifications by clicking on the bell icon. Alright, let's get started. In the previous episode of the series on how to trade Forex, we discussed what is Forex, the history of Forex trading, what are currency pairs in Forex, and how Forex trading happens in real life. When we mention the price of Forex currency pairs, we mention the price of the pair like 1.5483. For Euro US dollar, we could say the price of the pair is 1.5483. You might have noticed that there are 4 decimal points in the price representation. Generally, in currency related representations, we only consider the price value into 2 decimal points. However, when it comes to Forex transactions, things are a bit different. In Forex trading, we are considering up to 4 decimal points when pricing the Forex currency pairs. Let's say that the Euro US dollar currency appreciated to 1.5484 from the previous value, which was 1.5483. This change of 0.0001 has a special name to it. It's called a pip in Forex. Pip is a unit that we commonly use in Forex. When it comes to the accuracy and achievement of a trade, it's usually measured by pips. Pips says a lot about the accuracy and the achievement of the trade rather than the amount of money that you earn from that trade. We can understand the real performance of a trade when we calculate the achievement by pips. For example, if we make a good trade, we are saying that we achieved 50 pips or 100 pips from a trade. The pips gain is a really good indication of the risk management and accuracy of the trade. Among the Forex trading community, 50 pips and 100 pips are considered the standard average pips gain for a Forex trade. Let's say that we are making a trade by selling US dollars to buy euros. Let's imagine that we are buying the euros at 1.5483 US dollars. Let's imagine that we are selling the euros when the price reaches 1.5484 in the market and gain a profit of 0.0001 US dollars. In addition to pips, there's another measurement that we use in Forex which we call a pipet. A pipet is a smaller or a micro version of a pip. When you start monitoring the charts, you'll be able to see that there will be 5 decimal places for some currency pairs. For example, some brokers offer 5 decimal places for Euro US dollar like 1.54845. If the price of the Euro US dollar gets appreciated to 1.54846, we call it as 1 pipet got appreciated. A pipet is equal to 0.1 of a pip. When we trade Forex, we will not be able to purchase currencies like 1 euro or 2 euros like we do when we are buying shares through a stock exchange. In Forex, we will have to purchase currencies in lot sizes. There are a couple of lot sizes that's available in the Forex market. Lot sizes in the Forex market do have their standard names. We call them standard lot, mini lot, micro lot, and nano lot. The standard lot represents 100,000 units of the currency that we are going to purchase. If you imagine that we are going to make a buy trade for Euro US dollar for a standard lot, that means we are going to purchase 100,000 euros by selling the US dollars. And the units will be the same if you are making a sell trade as well. A mini lot in the Forex market represents 10,000 units. When we are buying a mini lot of Euro US dollars, this means we are buying 10,000 euros by selling the US dollars that we have. And a micro lot in Forex market represents 1000 units. When you are buying a micro lot of Euro US dollars, this means we are buying 1000 euros by selling US dollars. And a nano lot in Forex market represents 100 units. When you are buying a nano lot of Euro US dollars, this means we are buying 100 euros by selling the US dollars that we have. Most of the Forex brokers do offer fractional trading, which means you can make a trade for 0.01 from a standard lot. When you are creating a trading account, most of the Forex brokers do offer the ability to configure the lot sizes of the trading account. If you have a small capital like 100 US dollars, you can choose micro lot or even smaller lot size to trade with. Let's imagine that the price of Euro US dollar is 1.54837 and when we are buying a standard lot, we need a capital of 154,837 US dollars in our trading account to facilitate that trade. To be honest, that's a pretty big number, and most of us do not have such capital to start off forex trading. And that was the reason why forex trading was only available to the institutional traders before 1990s, as many of the individual traders were not able to afford such large capital investment to trade forex. To tackle this problem, there was a concept called leverage introduced to the forex market. Leverage is not only used in forex trading. Leverage is used in almost all the financial trading products, including stock exchanges, commodity markets, and all types of financial markets. Leverage wasn't something new to the financial markets back in the days. What leverage really does is it extends the buying power of the trading account to a higher value than what you actually hold in your trading account. Leverage is often offered as 1 to 20, 1 to 50, 1 to 100, 1 to 200, 1 to 400, and some of the forex brokers do offer leverage up to 888. When you are writing the leverage, we write the leverage as a ratio. The first number mentioned in the ratio is the amount that represents the cash input from the trader's trading account. The second value mentioned in the ratio is the amount that the broker will provide you as the leverage to extend the buying power of the trading account. If you imagine that we do have $100 in our trading account, and when we have configured 1 to 100 as our leverage in the trading account, our buying power will be 100 into 100, which means our buying power will be $10,000. When there's more balance in the trading account and when the leverage is higher, we are able to purchase assets worth of higher amounts. Likewise, if you have $1,000 and if you have configured the leverage of the trading account as 1 to 200, the buying power of the trading account will be $200,000. Let's imagine that we are entering into a trade for Euro-US at a rate of 1.0789 to buy 10,000 units of euros, which means the value of this trade will be $10,789. If you imagine that the Euro-US that we purchased earlier at 1.0789 reaching to 1.0889. After Euro-US reaches 1.0889, let's imagine that we are selling 10,000 euros that we hold right now. So the gain from each euro that we sold will be $0.01. As we have sold 10,000 euros, our total gain from the trade would be $100. If we consider that we have invested $10,789 into the trade, the profit that we can gain from the trade is approximately 1%. However, if we have configured the leverage in our trading account to 1 to 500 to buy 10,000 euros, we will only need to have $21.58 in our trading account. If we compare the profit that we could get as $100, it's almost 500% return on the initial investment capital required for the trade. Leverage is an interesting concept that will be very helpful when we are growing a trading account with a small capital. However, the leverage doesn't work favorable for us as always. It has some downsides when we are making a loss from a trade. Let's imagine that we have $21.58 in our trading account and we are going to make a buy trade on Euro-US to buy 10,000 units at 1.0789. Unfortunately, if the currency prices drops to 1.0769, our loss from that trade will be $21 because of the leverage that we have used for the trade. If you want to hold on to your trade, you will have to extend the margin by funding your trading account again. If not, your trade will be closed when the minimum margin requirements are exceeded, and the loss of the trade will be deducted from your balance in the trading account. When trading forex currencies, it's required to maintain healthy, free margin levels in your trading account. This shouldn't be done by funding the trading account over and over again when the trading account receives margin calls. Because of this reason, margin trading products like forex might not be suitable for every trader. However, we can control the risks involving the trades through our trading strategy, and we'll be discussing about those in the coming episodes. Apart from leverage and margin, there are a couple of parameters that you should know when trading forex. When forex trading, we do have a concept called equity. Actually, the concept of equity is not only persists in forex trading, it's there in almost all the trading products. Equity of the trading account is the trading account's balance that we have plus or minus the profit or loss that we have from the active trades. Let's imagine that we have $1,000 in our trading account and we have an open trade of Euro-US that has an active profit of $80. Then the equity of our trading account will be $1,080. Likewise, let's imagine that we have $1,000 in our trading account and we have an open trade for Euro-US which has an active loss of $40. In such scenarios, the equity of our trading account will be $920. Let's say that if we had the trade open for overnight and there's a swap of negative $5, then the equity of our trading account will be $915. Equity will change all the time when there's an active trade in our trading account. In this episode of the series, we discussed about what are pips, what are pipettes, what is leverage, how leverage works, what is margin, how margin works, the risks of margin trading, and what will be the equity in our trading account. In the next episode of the series, we are planning to make a deep dive into the trading app to cover the essentials to advanced features that will be really useful as a trader. If you have any questions about what we discussed in this episode, please feel free to comment your question in the comment section. Or else, if you need a free consultation, you can schedule a quick call with me by visiting the URL thekisaki.com/connect to reserve a time slot. If you were able to learn something new from this episode of the series, please consider subscribing to the channel. To get notified right away when we release a new video, don't forget to enable alert notifications by clicking on the bell icon. You also can follow us on Instagram, Facebook and TikTok. Our handle goes as kisaki.finance. And it's a wrap then. Hope you enjoyed it and thank you so much for watching. I will see you in the next episode. Until then, stay safe and take care.